to this investment manager update by Gryphon Capital Investments. My name's Fraser McCausland and I'm a partner at Seed Partnerships. I'm pleased to be joined today by Stephen Fleming, the Chief Executive Officer of Gryphon Capital, and by Ashley Burtenshaw, the Chief Investment Officer.
Thanks, Fraser.
Thanks, Fraser.
Steve, I might start by asking you to just provide investors with a recap of GCIT and how the last 6 months have been.
We all know 2020 has been a very challenging time, both professionally and personally. COVID-19 has forced us all to adapt and be more resilient than ever before. With this in mind, I would like to thank all of our clients. You should know that the entire Gryphon team has been working incredibly hard on your behalf, and we're delighted that this hard work has paid off in our performance. Gryphon manages the GCI portfolio to achieve 3 core objectives, being sustainable, predictable monthly income, high risk adjusted returns, and most importantly in these uncertain times, ensuring capital preservation. During the peak of the crisis, due to the market uncertainty, the market experienced heightened volatility, resulting in falls in asset prices across all markets. GCI invests in secured bonds, RMBS and ABS, with each underlying investment priced daily by a leading independent price provider. The market values of each investment forms the GCI Net Tangible Asset, or NTA, with the GCI NTA announced each day to the ASX. Secured bonds have multiple layers of protection against loss, so historically have been a defensive asset class, experiencing low NTA volatility. Pleasingly, during the crisis, the GCI NTA was true to label. Yes, we experienced a small decline in the value of NTA, less than 2%, but today, the market values of the GCI investments have fully recovered, as reflected in the NTA published to the ASX, which today is above 201. This is a great result for our investors. Since listing, Gryphon has always exceeded our target income returns of RBA cash plus 350. And even in the last 6 months, when traditional sources of income has been falling, Gryphon has been able to increase our distributions, exceeding our target returns by a larger margin. Another great result for our investors.
Thanks very much, Steve, and congratulations to you and all the Gryphon team for a terrific year of performance in what's been very trying times. I might ask Ash now for you to make some comments on what most investors will be interested in, and that's your outlook on the mortgage market.
Thanks, Fraser. I thought the best way to address the outlook, to quote Warren Buffett, is now the time to be greedy in our pursuit of achieving the highest risk-adjusted returns for our clients. We believe so, but how can we be so certain? Shoshana Zuboff, author of The Surveillance Capitalism and Harvard professor, made the following remarks about the dominance of the social media platforms. Social media platforms do one thing: they sell certainty to advertising companies on the success of their ads. Therefore, you have to make bold predictions regarding the potential success of the ad. To make bold predictions, it starts with one imperative: you need a lot of data. At Gryphon Capital, we too have a lot of data. So, what is it telling or informing us? The COVID-impacted borrower has been reflated by the sheer quantum of fiscal stimulus from the governments. Compared to the crisis in 2008, the stimulus was at 4% of GDP. Now, as we've hit the pandemic, we are now standing at 11% of GDP of stimulus. Also, household savings has risen from 6% to 19.8%. We've seen this evidence of this through our mortgage lens, whereby borrowers are paying down their debt at such a rate you could be mistaken that Australia is going through a property boom. Who would figure? We often quoted in the press by saying RMBS bonds thrive in a low mortgage rate environment. Why? Because it increases affordability through it lowers your mortgage repayments. This has shown up in the percentage of borrowers that are behind on their mortgage repayments by more than 90 days. Interesting, this percentage has been very, very stable, hovering around 0.35%, which is the same level as it was about a year ago. Now enter the new game in town, or the new RBA regime, i.e. use it or lose it. What does it mean? Use it, the banking system has been flooded with cheap money, and lots of it. And lose it, the RBA will pay 0% on excess funds placed back at the RBA by those banks. So it appears it's all about the extension of credit. Who benefits, who loses. History tells us that prime borrowers will benefit in uncertain times because of their predictable behaviour when it comes to making mortgage repayments. Whereas the weaker borrower is likely to miss out on a better deal due to their repayment habits, which at times can be deemed unpredictable. It also helps having a more normalised approach to responsible lending, making it easier, and what we mean by that, quicker turnaround times for credit to get into the hands of the Australian consumer. Reiterating the theme, it is all about reflating the consumer and to restore consumer confidence with the goal of getting the country moving again. On housing, we remain hesitant to forecast due to the lack of recent data points that we've seen. But our bias is leaning towards a constructive outlook on the housing market here in Australia. Anecdotally, we can point to evidence emerging in the UK whereby the average national house offer price has increased month on month. This, coupled with a whatever it takes attitude by the government, has our investment committee coming around to the view that the Australian housing market is at or close to its peak to trough cycle bottom, and that's important. Lastly, we couldn't finish this topic without a reference to what is happening to all those COVID impacted borrowers who have elected hardship or a modified payment arrangement. In our previous market update back in the eye of the pandemic storm, May of this year, we referenced the level of COVID borrowers in our GCI portfolio by applying a multiple of cushion over the level of the COVID borrowers. We expressed the cushion as a multiple to illustrate the robustness of the portfolio in times of extreme stress. At the time, the multiple was approximately 3 to 4 times before our analysis revealed the performance of the GCI holdings could become uncertain. Good news, fast forward to today, approximately 60% of those impacted COVID borrowers have cured. And what we mean by that, back in line with their scheduled repayments, implying the multiple of cushion has ratcheted higher to 7 to 10 times over this window of uncertainty. Hence, all the data paints a picture, reinforcing our belief that there is no better place to invest when you are seeking sustainable, predictable income, driven off bonds that are engineered to bend, but very hard to break. And therefore, we hope now, like the team at GCI, you too are of the opinion, with certainty, Australian RMBS bonds are truly loss remote.
Thanks very much, Ash. And what a timely reminder to investors of the data-driven approach that Gryphon take when constructing a portfolio of bonds on behalf of unit holders.
Thank you, Fraser.
Steve, I might turn to you now. Certainly a very interesting year in portfolio construction. Can you talk a little bit to investors about how the portfolio of GCI has evolved over the last sort of 6 to 12 months and how it's set up for a post-COVID environment?
Sure, thanks, Fraser. The Gryphon Investment Committee, or IC, has been able to draw on our collective experience during other periods of market stress, when a combination of Russia defaulting and a failure of a US hedge fund long-term capital caused global credit markets to go into freefall. There was the Asian financial crisis, there was a European debt crisis, and the GFC. It was with this experience that the IC agreed our guardrails to protect our portfolios against market stress. 3 of the key themes in Gryphon's portfolio allocation through 2020 has been, firstly, an increased allocation to the most predictable and stable asset class, in our investable universe, which is prime RMBS, the asset class less impacted by COVID. Secondly, we sought to extend the credit duration of our portfolios as we want to look to lock in the higher returns we were receiving during the crisis for longer. Thirdly, we supported only the top tier originators, the best performing programs with long histories of outperformance. Importantly, our data advantage and investment process provided us with the clarity and confidence in our portfolio construction. We also knew that after the market stress we experienced in March and April meant only the best originators with the most conservative transactions would be able to come to the market. It was at this time Gryphon pivoted from defence to offence. We had done the hard work and we were confident being a major investor and reopening the RMBS market. Not only were these transactions conservative and issued by top tier originators, but importantly, due to the market stress and lack of other investors, they also represented strong relative value, hence the increase in GCI's income distributions.
Thanks very much, Steve. Yes, what an extraordinary period of stress that we've just come through as a result of this global pandemic in COVID. During periods like this, diversification is obviously very important when you're looking for predictable and stable income. How does Gryphon achieve that diversification in your portfolio of bonds?
Sure, Fraser. GCI invests in RMBS bonds which are secured by home loans. When investing for income, diversification is very important, and Gryphon achieves diversification through investing in RMBS secured by a very diversified portfolio of home loans to Australian borrowers. The GCI portfolio currently has invested in over 90 RMBS and ABS bonds, with the RMBS bonds secured over a diversified portfolio of home loans, which in aggregate total over 114,000 home loans across Australia. Each month in our investment update, we detail some of the portfolio attributes enabling our investors to look through to the large portfolio of residential home loans, remembering GCI invests in RMBS bonds which is secured by these home loans. On a portfolio basis, GCI has exposure to over 114,000 loans to borrowers who have, on average, 35% equity in their home. At an average property value of $720,000, an LVR of 65% means the average borrower has over $250,000 equity or first loss protection in their home, whereas the average interest rate is 3.66%. The diversification of the look-through portfolio of home loans and the borrower's equity in their home for GCI, that's on average $250,000 per borrower, are the key reasons why no Australian RMBS investor has ever lost capital when they hold their bond to maturity.
You mentioned in your comments the monthly report, which has always been detailed and very transparent. We know that's important to investors. Ash, I might get you to comment on how important unit holder communication is to the Gryphon team.
Thanks, Fraser. Yes, time has proven to be the best measurement of success. This level of reporting borne out on October the 15th, where we saw the GCI units trade at a premium for the first time since February 2020. In round numbers, units traded at $2.01 versus a NAV of $2. Our strategy at Gryphon Capital for unit holder engagement centred around the integrity of the NAV. We believe this was the key to restore investor enthusiasm for the units in order to promote confidence on delivering on our third pillar, preservation of capital. But we couldn't rely on the NAV alone. The market was throwing up a vast array of initiatives, policies and measures which needed to be communicated on a range of potential impacts driving our clients' investments. As we strive for the best in class in everything we do, our monthly reporting came to the fore in addressing the issues when they arose. We know different investors take different things out of the monthly report, but given the extreme nature of the pandemic, we felt it was prudent to extend the report to include comprehensive commentary around those issues that were making headlines that week, that day or month, occasionally turning the report into a 3-page report rather than our customary 2. However, when FUD appeared, which is fear, uncertainty and doubt, was approaching heightened levels, we took to producing a spotlight research article and also a series of investor calls to address the cause and root of such uncertainty. This approach to unit holder engagement will never change at Gryphon Capital because we see these steps as necessary to deliver a superior offering for all those involved. Finally, like you, we at Gryphon Capital also want a successful outcome, and therefore capital management is never off the table. But to date, we haven't had to dig deep into the quiver for the buyback arrow to achieve the highly desirable state of equilibrium whereby demand equals supply, as it did back on October the 15th.
Thanks, Ash. The increased engagement with investors during the course of this year has certainly been a feature, and I know appreciated by investors around the market. Well, that concludes the formal part of this investment manager update. One question we often get, and I might ask you to address this, Steve, is that if I can get a mortgage for 2.5% and Gryphon Capital invests in bonds that are backed by mortgages, how is it that you can achieve your target returns?
Thanks, Fraser, and I agree, great question, and one we often get asked, particularly by those new to Gryphon. The key to the answer is diversification and averages. Let's walk through the steps. An RMBS issue is secured by a diversified portfolio of home loans. These home loans are diversified by many factors, including geography, by loan balance, dwelling type, LVR, and also, and most importantly, interest rates. Not everyone pays the same interest rate. Yes, a pool may include borrowers paying 2%, but they also have borrowers paying 3% and even as high as high 3s or 4. So in a real life example of an RMBS transaction which Gryphon invested, the average interest rate was just over 3. So in this example, $1 billion diversified pool of home loans with an average LVR of 58%, meaning the market valuation of the homes mortgaged over the RMBS was circa $1.7 billion. The weighted average loan balance was $339,000, meaning the pool comprised of almost 3,000 home loans across Australia. To fund this $1 billion diversified pool of home loans, the bank issues $1 billion of RMBS bonds tranched into different credit ratings, from AAA and lower investment grade, which BBB and single A, to non-investment grade. The different credit ratings have different risk profiles. Different risk means different return profiles. The highest rated bonds are rated AAA, and almost 95% or 950 million of the billion are rated AAA. These AAA rated RMBS bonds are purchased by large international investors, and due to their very low risk, only return low returns, in this case just over 1%. The non-AAA rated RMBS bonds have slightly higher levels of risk, hence earn higher returns. Remembering each non-AAA rated RMBS invested in by Gryphon must pass our robust filters and stress testing, ensuring each and every position is loss remote. GCI invests in non-AAA rated bonds from AA down to non-investment grade, with the majority of GCI's portfolio rated investment grade. But remember, in this example, out of the $1 billion of RMBS bonds issued, there is only 50 million of non-AAA bonds. So while the bank is paying higher returns on these non-AAA rated bonds, almost 4% yield on the investment grade BBB rated bonds, the bank's cost of funding is driven by the cost of funding for the large AAA rated bonds at the very cheap 1%. So the average cost of funding for the bank is only a very low 1.15%. So how do the maths work? The bank earns on average 3% interest on the home loans. The bank pays bond investors a weighted average interest rate of circa 1.15%. The bank has other costs, including servicing of the loans, etc. So the all-in cost for the bank is around 2%. So the bank earns the mortgage interest rate of 3% and pays away the total cost of funding, circa 2%, with the difference being the bank's profit or excess spread. GCI invests in non-AAA rated bonds, receiving the higher returns. GCI has invested in a portfolio of over 90 RMBS and ABS bonds, each loss remote with different credit ratings and different return profiles, from less than 3% to over 7%. But the average investment return means GCI is able to meet its target return.
Thanks very much, Steve. I'm sure that's going to be helpful to investors to understand the diversification of bonds that sit in the portfolio for Gryphon and how you achieve those target returns.
Thanks, Fraser, and thank you, everyone.
Well, that concludes today's presentation. Thank you all who have participated, and particularly thank you to Steve and Ash for the update and insights into the portfolio.
Thank you, Fraser. And for those investors looking for some more information, you can visit the Gryphon website.
Investor engagement is important to us at Gryphon, so we would encourage you to subscribe to receive our monthly investment updates and our insights. Thank you.